Good afternoon and welcome to this deep dive webinar on valuations. My name's Andy Killick and I head up the corporate finance team at PKF Francis Clark. So welcome to you all and thank you very much indeed for joining. We undertake not just a significant amount of valuations, but certainly, and perhaps more importantly for some on the call today, a significant number of transactions that put the theory of valuations into practice, whether these are acquisitions, sales, management buyouts, employee ownership trusts. There's a very wide range of transactions that we do and a significant volume. And to put that in perspective, in the UK and Ireland last year, PKF completed more deals than Ernst & Young, Deloitte, in fact, compared to all of the big four. So it's a substantial volume of transactions we undertake as well that puts this into practice. And so we're very lucky today with a number of colleagues here to have significant practical experience undertaking valuations in theory and in practice. During the webinar, please don't hesitate to put any questions you've got in the Q&A session, and we'll try and address those during the webinar and do a catch-up at the end. So with no further ado there, I will introduce or allow my colleagues to introduce themselves. If I hand over to Nicola.
Thanks very much, Andy. I'm Nicola Manclark. I'm a tax partner here at Francis Clark, and I'm also a lawyer by background. I've got over 20 years of experience advising on corporate transactions, including trade sales, management buyouts, and employee ownership trusts. And I also advise on incentives as well, so employee and management incentives.
Thank you, Nicola. Matt?
Thanks, Andy. I'm Matt Willmott. I'm a director in the corporate finance team. I specialise in mergers and acquisitions. So I typically advise shareholders and management teams in trade sales, acquisitions, MBOs and EOTs. My experience of valuation comes from the coalface in terms of advising shareholders and negotiating transactions in order to actually find out what shareholders receive at the end of a deal.
Thank you, Matt. Adam?
Yeah, thanks, Andy. So my name's Adam. I joined Francis Clark in early 2022, having previously worked for Deloitte in Bristol. I'm part of the forensic and valuations team with experience in company and share valuations for various reasons, including sort of commercial, probate, litigation, that sort of thing, which we'll touch on in this webinar. I gained experience across a range of service lines before settling into valuations, which complement the skill set needed for valuations and analysing businesses and beyond, really.
Thank you all. So just to recap of what we're going to cover today, we're going to go through why do we undertake valuations and who do we value them for? What are the different types of valuations and bases then they can be carried out? And then looking at a bit more practical terms, how do we value companies and taking into account specific shareholdings, if they're minority or majority, the impact that has. And then we turn more from theory into practice. So looking at evaluation and then taking into account, as Matt was alluding to, in terms of transactions and deal structuring. If somebody values your business at 10 million, but they only pay you £1 up front and the rest on some dubious future items, you may view that valuation or price quite differently than if they were going to pay you 10 million up front. And would you even compare that to something paying you 9 million up front with £1 million to follow? So having looked at some of the practical bits in terms of valuations aspects and deal structuring, we'll then look at some of the steps at the end that shareholders and management teams can undertake to try and actually improve the valuation they have before undertaking a transaction and being adequately prepared for that. So kicking off on the first bit, we'll go to why do we undertake business valuations and who for? And I wonder if, Adam, if you could start off with that one, please.
Yeah, absolutely. So my role here is really to undertake independent and professional valuations, which are effectively standalone or sort of desktop valuations. And there's a number of reasons why we would do those. So one of those would be sort of succession and wealth planning. So shareholders want to understand what their business might be worth in the current market. So that's a very common reason why we do it. We've got options reviews. So shareholders want to assess the options available to them, to their business in the current market, analyze their business, what they might get. And this is where sort of valuations underpins wider sort of M&A thoughts and transactional thoughts, and that valuation is a key sort of pivotal part in what the business might be worth right now, what it could be worth in the future, what options shareholders could take to potentially enhance or maximize value, and whether a transaction is suitable. And then the third sort of key theme from my perspective would be litigation. So that could be, engage to value companies or shareholdings whether it's for matrimonial purposes, so that could be divorce, separation, where there's a business or an asset that needs valuing as part of that. Or disputes is another common one we see. So that could be shareholder disputes. So there could be a disagreement on sort of strategic vision, and a shareholder could want to exit the business. There could be a shareholder exiting the business and a lack of clarity in the articles of association or the shareholders agreement around what that percentage shareholding should be worth, and we can step in to sort of help untangle that. So yeah, anything sort of disagreement focused or disputes focused, and that's where we can step in to help, and we can act for the shareholder, or we can be appointed by law firms to act for a particular side, or we can act as an expert. It's what's called single joint expert capacity, and we essentially provide an expert determination and help facilitate an appropriate resolution, which can be held up in court, and it's designed to be sort of professional, independent, to withstand scrutiny in court. But the aim is always, as I'm sure a lot of you on the webinar can appreciate, to try and reach resolution before it gets to that stage, and that's where we can come in and help as well.
Okay, Adam, thank you very much indeed for that. Matt, I wondered if you could look at it from a sort of transactional perspective that you were alluding to earlier on.
So I think when we have our initial conversations with any business owner, they're quite keen to understand what their value, what the value might be for their business and what they might get out at the end of a transaction. So we might provide them with an illustrative valuation, but clearly until a transaction is done, that illustrative valuation is effectively meaningless. So it's not as if when we go to market, we market with a price tag attached to any business. We really have to go through quite a process in order to position the business, put it out there, attract the right buyers to maximize the value. So for most shareholders, where the objective is to maximize the value, it's about identifying the sort of buyers that are likely to want to pay more, because different buyers will look at the same information and they'll interpret it completely differently. So for any strategic buyer, we want to identify those that are going to have reasons to pay more. So the strategic rationale, the synergies that they're going to deliver, that might be cross-selling to customers, that might be some cost savings, it might be added buyer power, it might be to block a competitor from making the acquisition. So you've got the theory of what a business might be worth and then expectations from shareholders, but actually the reality will often depend on the process that you run and the buyers that you approach. And for any process that we're trying to run, it's all about identifying those strategic buyers early on and finding out what they want and what they value, so that we can position a business in a certain way to try and maximize it on a transaction.
So that's taking the theory quite a lot further in terms of the practical application. I think there's also a key point you mentioned at the outset. For many people used to selling houses, they tend to come with a price tag or a guide price. Whereas from a company who's selling those, we don't want to limit what somebody might view and value a business at. And then that all sounds great. So somebody gets their money. But I think there are two elements that, from Nicola's perspective, that can influence it. One, in terms of the valuation, but also two, when people get the money, it's the post-tax proceeds that really count. So Nicola, I wondered if you could add a few more comments from a tax perspective.
Yeah, of course. So from a tax perspective, you might need a separate valuation specifically for tax purposes, and that typically might be for capital gains tax purposes, where you've got a transfer of shares to a connected party, so somebody who's related to you, or companies which are under common control. And also another key reason for needing a tax valuation is whenever shares are transferred or issued to employees or directors, where there could be risks of income tax charges arising. So typically on a trade sale, there would be no need for any sort of separate tax valuation as such, because it would be a sale to a third party, and that's self-evident in terms of what the valuation is. But if you contrasted that with an employee ownership trust transaction, for example, you would typically need a valuation to ensure that the vendors are receiving a market value for their shares, which not only satisfies the trustees, but also in terms of the risks of employment tax charges arising on the proceeds. And then Another typical reason will be for any incentives which are or other equity issued to employees or management as part of a transaction, for example, on a management buyout, and also in certain private equity transactions where you might have a sweet equity pot for management. So those are the sort of scenarios where we typically see that you might need a valuation for tax purposes. And then, of course, as Andy says, that you're not only worried about what the value is for tax purposes, but also whatever you're receiving, what is the tax? What is actually the tax on those proceeds? And if you're selling shares, you will typically want to make sure that you're within the capital gains tax rates, which are 20%, but subject to business asset disposal relief, which can reduce it to 10%. For employee ownership trusts, it's a tax-free gain, and so you want to make sure that you're achieving whatever those rates, those beneficial rates are, and avoiding risks such as your proceeds being subject to income tax.
So thank you for that, Nicola. And I think the other area that you and your colleagues spend quite a bit of time in terms of planning before events, whether there's demergers, moving property around in structures, and in a number of cases, if they're moving around, valuations may be needed to help support that, get those established, agreed with HMRC before a subsequent transaction where the actual capital gain or other taxes is calculated on. So thank you for that, for all going through sort of explaining that. I wondered, having had the discussion of where in the circumstances, we could go through some of the practicalities. And Adam, I think from a technical point of view, you're best placed to go through that. I wonder if you could then walk us through undertaking valuation, please.
Yeah, absolutely, Andy. So yeah, I think, forgive me for reading off a screen here, but the best position to start would be around the definition of market value, and we're using here International Valuation Standards Council definition, and it's what underpins the majority of our valuations. We appreciate there's other valuation bases such as equitable value, but a large chunk of what we do is underpinned by this fair market value, and effectively it says market value is the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing and where the parties had each acted knowledgeably, prudently, and without compulsion. And I think sort of away in the theory here, when we're doing a valuation away from a transaction, there's a few key points to draw out there, just in terms of willing buyer and a willing seller. We have to look at it as if that's the case. In an arm's length transaction, so there's no sort of synergies, there's no strategic gain, it's just an independent arm's length transaction. Proper marketing and all parties knowledgeable. And I think there's some key points in terms of what underpins our theoretical valuations outside of a transaction. And that sort of alludes to the fact that valuations are an art, not a science, but we try to be as scientific as possible in terms of our approaches, and to make sure when we're valuing, we use methods and techniques that draw on sort of scientific aspects in for want of a better phrase, that support the valuation. So whether that's looking at historical transactions involving comparable companies as a good basis point, and I'll touch on that in more detail in a second. And there's two main valuation approaches here when talking about how we value a company and a shareholding that I want to delve into, and that's the income approach and the market approach. So I appreciate there's others such as the asset approach, which will be potentially better for more asset intensive businesses, but due to time constraints, we're going to focus on what's probably seen as the two key approaches, and that's income and market. And I think in an ideal world, income approach would be used predominantly for most businesses, because that's looking at the future cash flow of the business, discounting it to the present value, and by a suitable discount rate. And it takes into account, one, the cash flows, which are often seen as key in any sort of deal, any sort of company. Cash is king, the saying that goes around. But the discount rate also factors in some aspects such as the risk-free rate, which is the theoretical return on a risk-free investment, which government bonds are often used as a sort of comparative to get that. It factors in things like beta, which is a measure of the volatility of the shares valued compared to the market as a whole, and it's looking in particular at sort of systematic risk and things like inflation and war, which are quite relevant topics at the minute, and how these can't be diversified away, and where the company you're valuing stands in relation to that. And then things like market risk premium, so the expected market return, looking at comparable markets, less the risk-free return, and also these sort of nuances and technical points all form together and give the discount rate, which underpins the future cash flows, being the income streams and the costs and everything associated with that, to give a real sort of solid valuation. And the problem that we have when it comes to a lot of SMEs in particular and owner managed businesses is the data to do this income valuation, the discounted cash flow, just isn't available. So it's either it's not available or not to the extent it's required in terms of the level of rigor and scrutiny to get detailed projections that will stand up over time. And that links to just the market being so unpredictable for SMEs, and performance just varies completely with the market, and it's really hard to project, particularly for a period sort of 5 years plus. And then you've got considerations in the, and I can see you ready to.
It was just more from a practical point of view, Adam, is an example where can you have projections with a high degree of accuracy over the next few years in, let's say, a manufacturing business? That might be very difficult, maybe in a renewables business or something where it really is predictable for the next 20 years or so. So is that the contrast, where in those scenarios for many operational owner managed businesses, there just isn't the accuracy of the future data, and hence why you can't use that basis?
Yeah, you just put me to it there. So I was going to come on to the point about renewables and solar businesses in particular. A good example of it's easier to project the cash flows for those businesses, so it's much easier to use an income model, and our energy team in particular often do valuations as part of their M&A and sort of M&A transactional work using DCFs when they're valuing these energy businesses. So that is definitely one strand, and due to time constraints, again, we're limited in what we can cover, so we're focusing more on trading businesses here, where it's not as easy to predict. So the main sort of accepted approach, particularly in the UK, is this market approach and using multiples. But just to Andy's point there as well, I think there's a push in the European market to use DCFs on SMEs of all kinds, and within our PKF firm, we've got research to do with SMEs and betas in particular, for discounted cash flow and income valuations for SMEs of all kind in all different industries, not just renewables, and really are at the forefront of trying to progress that. But what's widely accepted in the UK at the minute is this market approach, particularly for these trading businesses where it's hard to predict future cash flows and with any real certainty and level of scrutiny, essentially. So that brings me on nicely, unless there's any other points from the room. It brings you on nicely to market and multiple, which we have prepared some slides for, if Saf, you're able to. Perfect, and hopefully that's visible and clear for everyone watching. It's a bit small for me, so if I'm squinting at the screen, just forgive me. So what we do with this market and multiple approach is we're effectively trying to first understand, as an overview, the maintainable earnings of the company, multiplied by an earnings multiple to reach enterprise value, and then there's some adjustments to reach equity value. And starting at the top there, maintainable earnings. So we acknowledge there's many different valuation bases for depending on the sector and the company. So if you take an advisory business or a tech business, you might look at annual recurring revenue. If you take sort of hotels, you might look at revenue per room, and markers like that. But for a lot of trading businesses, SMEs and owner managed businesses in particular, EBITDA is widely accepted as the starting point for this maintainable earnings calculation, and that's because it's seen to most closely correlate with the earnings of the business and the cash of that business from the income and expenses. So that's widely accepted, and that's what we'll focus on here, is using that reported EBITDA as the starting point for this maintainable earnings calculation. And essentially what we're trying to do with maintainable earnings is we're trying to calculate the earnings for the business that's sustainable into the long term, disregarding one-off costs, exceptional costs, non-trade costs that don't correlate to the operation of the trade, and any normalization adjustments. So as I mentioned, then you've got reported EBITDA as the starting point. Typical adjustments we'll look at in this is for exceptional non-trade items. We'll add back or deduct depending on which way they fall, and then normalising directors' remuneration. And the point here is a lot of SMEs or owner-managed businesses in particular, a lot of the directors are owners, and the remuneration is often linked to the performance of the business. Whereas if an independent third-party owner was to buy that business and not be involved in the day-to-day and place an independent manager or director in there to run that business for them, we need to reflect the market value of that salary that would be needed for that director or manager. So what we do is we tend to add back, if relevant, the director's remuneration going through the P&L if it's staggered depending on results, and we'll bring in this market rate adjustment to reflect what normalised salary would be going through the P&L should the shareholders not be involved in the day-to-day. And then similarly with rent, if the business owns the property that it operates from, there wouldn't be a rent charge going through the profit and loss. But in actual fact, to carry out that trade, you don't necessarily need to own the premises. So we value on the basis of, and we bring in what's called this notional rent charge, because we value on the basis that someone could come and buy the trade and operate it without owning the premises, but they would incur a rent charge through the profit and loss for that. So we factor that in as an adjustment as well when trying to calculate maintainable earnings. And then the other points to consider with maintainable earnings are over what period, and typically with a market approach, we're looking at current year earnings, but also we go back typically 2 years, depending on the business, again, depending on the circumstance, but we don't want to go too far back because it can be outdated. The results can be outdated. It depends on whether there's been a change in business model, that sort of thing, all sorts of factors which affect the period we're looking at. But we're trying to get a solid maintainable earnings figure over a reasonable period, which is essentially the business is able to carry that forward.
I think, sorry, Adam, from a sort of M&A practical perspective, when we're taking businesses to market, we want to position them in the best possible light, and there's a number of ways you can do that, and there's adjustments here that Adam's talked about. There's no hard and fast rules as to what is a valid adjustment. There's guidelines, and it's all very much a negotiation about how you can position it. So understanding some of those items can make a big difference to the valuation, and also how buyers will interpret it. So, as Adam's mentioned, it might be on the current year, but if you're a business that's actually, there's reasons why the current year or last year might be exceptional for right or wrong reasons, and you want to direct a buyer to a certain year over another. Again, it's the communication with the buyer and the emphasis on particular figures that promotes a better valuation. So, for example, I'm working with a manufacturing business at the moment that's had supply chain challenges, and last year profitability wasn't as high as it should have been. So we're definitely pushing them towards current year, and actually next year looks even better. So we're trying to get it between sort of current year and next year. And if there's growth, clearly we want a valuation based on a higher EBITDA, if possible. So just a few nuances when we come to actually take a business to market, and ways in which we can position it to essentially maximise value.
I think, as Matt has alluded, there are a whole variety of other items of expenditure that may be one-off costs that can be adjusted for. A topical matter at the moment is people's power costs over the last few years. To what extent is that an exceptional item? Should that be adjusted for or not? And hence why you can see these areas are grey. It's, as Adam was saying, an art rather than a science in terms of those adjustments. So back to you, Adam, then. So in terms of some of the other items that may affect in terms of the enterprise value?
Yeah, I think we've got a real good flavour of that, and it's really good to get the practical aspect and perspective there as well. And that shows the difference in what we're trying to do in theory when we're valuing and we're trying to cover all these adjustments, but actually it stems that back to if you undertake a transaction, what happens on that transaction. But yeah, we were at the maintainable earnings point and looking at periods and saying, well, we try and get a sustainable period to back up the maintainable earnings figure that we're using. And similarly with average and weighting, we're just trying to make sure if, for instance, looking at the last 3 years, a particular year was skewed for example, COVID, or maybe the business has been hit worse by the conflict in Ukraine or by inflation, then all these factors are considered when we're looking at our average and our weighting when we're trying to think, well, what's maintainable for the business going forward. And that takes us to the next slide, which I think I can draw. Yeah, when looking at the earnings multiple. And effectively, with an earnings multiple, because we're focused on an EBITDA here, we're looking at EBITDA to EV, and EV being enterprise value. We're looking at EBITDA to EV multiples. And there's various ways you can derive a suitable multiple. There's lots of publications out there. For instance, the Private Company Price Index, you've got Market to Market. They publish their own indices, which all give you a flavour of multiples. But these are typically quite broad in terms of they don't differentiate between company size or necessarily industry. But one of the tools we use is to look at historical transactions involving comparable companies, just to get an understanding of the multiples achieved by those companies in those transactions. And that's a really good, and I say it in quotation marks, but scientific, is a really good way of looking at what's actually happened in the market as a good indicator of what could happen for the business that we're valuing. And another approach could be, if we have a business that's quite a large private business, we can look at public comparables because the price is readily available for them. And that's a good benchmark as well. But that brings in all sorts of other considerations, such as discount for what's known as a discount for a lack of marketability, where if you're a public company, you can realize, and a shareholder in a public company, you can realize cash pretty much instantly by selling shares. And that's very much different for a private company who will have to go through a transactional process, which could take a few months, a year, depending on the horizon and the process itself. So there are a couple of the common methods we use to try and derive an appropriate multiple, but then we have to bring in these company specific adjustments when we're looking at a business as well. So it might be that we've used historical transactions involving comparable companies or comparable sectors, but actually maybe the average EBITDA and enterprise value of those companies involved in those transactions might be significantly higher or lower than the company we're valuing. And a higher company is typically seen as more appealing and less risky to potential investors, which would command a higher multiple, which is what lots of the data have referenced backs up as well. It could be specific factors, as we've listed there, dependency on owners. So and in the real world, if there's a dependency on owners, does that warrant a handover period? And that's factors we'll consider later. But does that mean it's harder to replace the owners if they exit the business straight away, and will the business suffer as a result of that? Customer concentration, as another example, is there a risk that is there reliance on one customer, and a risk that if that customer goes elsewhere, the business and the earnings are severely diminished? And current trading and trends and prospects, which we've covered anyway up to this point. And that all that sort of thinking and research goes into trying to derive an appropriate earnings multiple to apply to maintainable earnings to reach an enterprise value, which is what's deemed the value of the trade.
So Adam, just summarising there, there's a lot of uncertainty rather than just taking a specific number as a multiple. and by the sounds of it, and all the variations you've just gone through, but also in terms of the maintainable earnings, in terms of what period does that relate to? Is it history? Is it projections? And certainly I know, Matt, you've probably got a few views on how you do that undertaking transactions.
I mean, I think the answer is if you're selling, you're trying to maximize value, you position it in a way that suits you best. So if you're going to be expecting some growth, you're going to win a new contract, you're entering new geographies, whatever it might be, you may actually present several years of projections if there's growth, because ultimately any buyer is buying the future of this business. They're not buying the past. They're only using the past to understand where the business is today. So we may even present financials in a completely different way to what the accounts do. So, for example, if you've got a business that has a number of depots and perhaps one depot or location was only opened partway through the year, you'll make adjustments to improve the profitability to assume that all the depots are open for a full year, so you have a run rate. And so there's different ways of manipulating the financials to basically best serve your purpose.
Thank you for that. So, Adam, is there a further slide to help us understand how we go from the enterprise value to the equity value?
Yeah. One final slide, which I'll touch on lightly because I think Matt will cover it in a bit more detail later. But there's the premise of equity. Enterprise value is value of the trade. Equity value is value of the shares. And what you have to consider is all the non-trade aspects that will sit on a balance sheet. So in a theoretical valuation, we'll look at things like cash and debt-like items that the shareholders, if they've got cash in the bank, should be entitled to, and if there's debt incurred by the existing shareholders to run the business, and that is deducted as part of these adjustments to reach what's called this, or to calculate this cash-free, debt-free, and equity value. And in that you have a working capital consideration as well, which a lot of these they go into great detail as part of transactions now. And as I say, I'll let Matt touch on them in more detail after this. But that's the premise to get from enterprise value to equity value. And then just the final consideration from me when you reach equity value, being the value of 100% of the shares, if you're valuing a shareholding percentage, what happens then? And effectively, as you'd expect, that shareholding percentage gets prorated. So say if you're valuing 100% and you got 50% shareholding, you'd have half of that. But then there's also what's called a minority discount, or a discount for a lack of control, that's factored into these theoretical valuations as well. And this is just effectively saying that as a shareholder, if you don't have control, you don't have control over the cash realization, over the decision making of the business and the direction, and it's just a widely accepted discount that's applied when looking at non-controlling interests and shareholdings in a business. And just as a flavour, so there's all sorts of publications and literature on this, whether it's HMRC or ACCA or ICAW, but HMRC's indication is, if, for example, if you have a 50% shareholding, then there's a 15% discount against the prorated value of your shareholding. On this basis, when we're looking at fair market value and theoretical valuations, that you don't have control of the business and your overall cash realization. But again, in practice, this could well be different and will be touched on, I'm sure.
So Adam, thank you for that. You alluded to some of the factors there, cash and debt. It all sounds very easy and obvious. People know what the cash amount is and the debt amount, but my understanding, Matt will go into more detail of why it isn't quite so simple, and a lot more needs to be taken into account.
Correct. So when you receive an offer for your business, and when you enter into heads of terms, which is the document that outlines the key terms of a transaction, the offers will typically be on an enterprise value. So it will be debt-free and cash-free. And so what that means is you've got a good indication of what the enterprise value, or you know what the enterprise value is, subject to due diligence, but the shareholders don't actually know what they're going to receive in cash. And the reason why that's sort of so important, because clearly cash and debt from an accounting perspective are relatively easy to define. But as Andy said, there's a number of areas which are very grey, and particularly in the current market, there's huge emphasis from advisors to focus in on some of these elements because they are essentially an ability or an opportunity for a buyer to chip price if it's not positioned correctly. So as a recent example, we had a buyer looking to adjust for 2 million of items, and these included things like deferred income, perhaps holiday accruals, dilapidations, all sorts of things that you wouldn't traditionally define as debt. They were trying to put in as debt, and we managed to negotiate it down to a few $100,000 because the client was keen to actually get the deal done. But essentially, it demonstrates the sort of gulf that it can have if the buyer takes an aggressive approach, and what that means for the shareholders could be a lot different to what they expect. And so actually getting that agreement and negotiating some of those things up front, really understanding what the components of the balance sheet are, and getting that negotiation right can have huge value for the shareholders when it comes to what they actually receive.
And so, Nicola, do you have any comments from a tax point of view, the impact on that, EV to equity?
Yeah, so a couple of things there. I mean, first of all, you normally expect the ordinary course tax to be treated as a debt, so in terms of the current liabilities for tax, but there also can be future tax liabilities and assets which might potentially be taken into account. So for example, in a property rich business, there will be a latent gain in those properties often, and then the tax liability which would arise on an eventual sale of those properties could be factored into the valuation. On the other hand, there could be tax assets in the business. So, for example, tax losses or a deduction created by the exercise of share options before completion, for which the sellers can argue that they can receive value.
So just on that last one, can you just explain how you get value for if you've issued options to management or staff to incentivize them? How can I get an asset value from that?
So when those options are exercised, which would be typically just before completion, a corporation tax deduction is usually available based on the market value of the shares which are issued as a result of the exercise of those options. And so the value of that will be the corporation tax rate, so currently 25%, times the market value of those shares issued. And that's an asset which arises during the period of the seller's ownership, and so often you can argue that the sellers should receive the benefit of that because the tax of the company will be reduced as a result.
Thank you all for that. So based upon that theoretical background that Adam put forwards, it's clear that conceptually it's very simple. Maintainable earnings times by multiple. Where the complexity comes into is what are the maintainable earnings? With all those adjustments, are they forward-looking? Are they projections? Historic? How do you come up with the right number? And then even the multiple. There's a whole range of factors that actually affect the multiple to be applied. And that's before you've even got down to all the adjustments in terms of going from that value of the trade, the enterprise value, to get to the equity value. And as shareholders, really, there's one number that matters. It's that equity value and that post-tax equity value. So hopefully you can see there's a significant range of factors to take into account for that in practical terms, rather than just going from a desktop valuation. And I think if we could move that into the next stage. So we've talked about basis of getting to a valuation, but actually in today's world, especially with interest rates and where some traditional debt providers are understandably being a little bit more cautious, that may have an impact on deal structures. And therefore, I wondered if you could all go through in a little bit more detail about what you're seeing in the market. How does it compare from that overall valuation to the deal structure where you may actually, as a shareholder, get the money?
So I'll go first on that. So you might reach a valuation with a buyer, and it might be a very good front headline valuation. But what's important to shareholders is what's the certainty or risk around receiving that value. So the simplest form is cash up front. Clearly most shareholders want as much cash up front, so they want a high valuation and they want all that certainty and paid at completion, and that's fully understandable, but it's not the reality in all cases. So in terms of that, if you don't get cash up front, you might be offered it on deferred terms. So it's a fixed amount paid at a fixed amount or a fixed date in the future. So your risk there is around timing. You need to understand the credibility of the buyer, their means to come good with the money in several years' time potentially, and what security you might be able to achieve from the buyer during that period. And then thirdly, if you're not paid it at a fixed date and a fixed amount, you might be paid something called an earnout, and that will be an amount subject to a future event. So that might be performance of the business, it might be profitability, it might be turnover. That the rules are essentially open to whichever structure that a buyer and a seller want to put together for that. And clearly, for any seller thinking about an earnout, they might dismiss it offhand straight away because it's future risk and it's uncertain because it depends on a future event. But what we've certainly seen, particularly in the current market, to bridge valuation gaps between buyers and sellers, it can be quite a useful tool, particularly where sellers have got some influence. So you wouldn't necessarily want to agree to an earnout if you're not in the business or not able to influence the outcome of that earnout. But typically a buyer is going to want you to achieve that earnout because it suits their purposes, particularly if it's growing the business, because it's making the business better. So if actually you've got a motivated buyer that will support an earnout, there can be a great opportunity to actually have a second bite of the cherry, get a good valuation and payment up front. But if actually you can get sort of a cherry on top with the earnout, it's a way in which you can basically use the buyer's resources potentially to get much more consideration than you would have if you wanted to get it all up front. But I think the sort of the implications on shareholders there in terms of the timing of cash and the certainty will have implications on the sort of tax of those. So Nicola, if you want to cover that.
Yeah, thanks, Matt. So in terms of those three basic structures that Matt talked about, the tax treatment is a bit different in each case. So when you sell shares, you expect to be taxed at capital gains tax rates. So that's 20% for higher rate taxpayers, but subject to the availability of business asset disposal relief, where there's a tax rate of 10% for the first $1 million of lifetime gains. And so the rates are quite advantageous currently. In terms of upfront cash, then that will be taxed and the tax payable by the 31st of January following the tax year in which the sale is made. So that's relatively straightforward. If you've got deferred cash of a fixed sum, then you have to actually bring in that whole amount into that initial calculation and again paid at the same time. So there's some thinking there to be done in terms of, do you have enough of the cash up front to pay the tax on the whole amount, and what the timing is, because if you complete exchange and complete after the 5th of April in the year, then you've got longer in which to pay the tax, and thinking about when the deferred payments are going to be made and when you're going to get that cash to pay it. And then finally, for an earnout, it's slightly more complicated in that you need to actually value the right to that earnout, pay tax on that at the same time as any upfront cash. And then when the earnout is eventually received, you have to then do a further separate capital gains tax calculation based on the amount you actually receive less that valuation. And some of the things to think about there are that second calculation, that second receipt can't qualify for business asset disposal relief. So it's often to your advantage to try and argue for a higher value if you can, if you'll qualify for business asset disposal relief. So there's some points to think about there in terms of what that valuation is. And then finally, sometimes a deferred element, either the fixed deferred or the earnout, could be satisfied in loan notes or shares, and then you can usually then get what's called rollover treatment, so you don't pay the gain up front, but only when the loan notes or shares that you receive are eventually redeemed or sold. So quite often you'll see different combinations of all these types of consideration as well. So it's important to sort of think about what the tax treatment is and what reliefs you might qualify for and how to manage the timings as well.
So thank you for Nicola going through that, looking at it from the transactional perspective. And I think some of the other aspects that you'll go through with clients is the difference from a tax perspective for inheritance tax at the moment, with that still in there in terms of preference shares or loan notes. My understanding being that if you've got it in cash or loan notes, it's treated as inside your estate, whereas if it's actually preference shares, they potentially will fit outside your estate and therefore may have an impact for more elderly shareholders, whether they want to consider that as part of the structuring impacting on their own tax rather than the transactional tax.
Yeah, that's quite right. So business property relief will often be available for shares, which can mean that there's no inheritance tax. But for loan notes and cash, that's not the case.
And that probably brings us into more topical matters today in terms of the uncertainties going forwards into next year, having had a number of political parties conferences. There may be the political uncertainty, the impact on tax, the cost of debt, whole variety of factors that are affecting deals in the market today. And I just wondered if you could all, perhaps starting with Adam, first of all, just briefly in terms of some of the factors that are recently affecting valuations.
Yeah, I think the one thing for me that I'll touch upon is the cost of capital and how that's gone up, particularly in practice with transactions. Interest rate increase means increase in cost of debt, cost of capital, and an increase in the required return on investments. So I think it's just a point to consider, particularly if you're looking at a debt-backed purchase. It's a point just to consider the fact that the cost of debt's gone up. It might mean that there's less debt available to contribute towards the deal, and it might mean that the valuation is lower because of this increase in the required rate of return. So I think that's probably a topical one at the minute that I would sort of highlight up front.
So in a nutshell, therefore, you're saying some people may have a theoretical value, but because the cost of debt to actually buy that business is more, they may actually say they'll pay less, but also the deal structure may change, so vendors get less upfront. So quite a double whammy there, potentially. I wondered, Nicola, in view of the tax concerns, and there is a question there in terms of on business asset disposal relief, I wondered if you could pick that one up as well.
Yeah, of course. So with the general election around the corner, there's always a lot of crystal ball gazing in terms of what's going to happen to tax rates and the tax system generally. And I think the message is generally at the moment that it's unlikely that rates will go down. But what's more likely to happen is that they'll be tinkering with various reliefs. So one of the main reliefs, which I've been talking about a lot, is this business asset disposal relief. So will that change? Will the rate change? Will the lifetime allowance go down? Will it be withdrawn altogether? So that's one concern. Then corporation tax rates have gone up, of course, this year from 19% to 25%. And so in terms of the values of businesses, that can affect what the current value is, because the tax rate will be higher in the future.
So even though we've got a theoretical valuation that we were talking about earlier on at the EBITDA level, i.e. the earnings before interest, tax, depreciation, amortization, there's still that practical concern for people, the buyers, saying, well, actually the tax rate is higher and therefore the actual cash they'll get from that investment will be lower.
Yeah, exactly.
Okay, thank you for that. Matt, I wondered if you could sort of pick up on that theme. What else is happening in the current market in terms of valuation?
I think we're seeing quite a divergence in terms of multiples and how buyers are assessing targets. So there are still good valuations for premium businesses. Buyers are always asking how defensible is a particular business? What are the barriers to entry? What competition do they have? And that probably extends to the company's own customers. How resilient are they? And there's a greater focus at the moment as to those businesses that have the niche, that are able to demonstrate their resilience in the current market, and they're able to achieve continuingly strong multiples. I think at the other end of the spectrum, you've got those that are, I guess, more heavily influenced by macroeconomic factors, whether that's cost of living, consumer spending, etc. And those deals are certainly a lot weaker, and in certain cases, just not happening altogether. So we are seeing a drop in volumes. I would say that's accentuated at the larger end, particularly the sort of debt back. There's the sort of IPOs. They've slowed down significantly, but at the SME side, it has slowed, but not as much. The SMEs are much more resilient, and the transactions are still continuing. So, I mean, that's that's really good to see. I think looking ahead, for anyone looking at a transaction, going back to Adam's point around debt, certainty of a transaction has value, and understanding whether the buyer has the means to undertake the transaction. Do they have the cash on the balance sheet? Are they private equity backed? Are they a family office that they've got the funds? Because those are the credible buyers that you want to identify in a process, because you don't want to go through a huge long process for months and months and find out that the buyer's funding has been pulled because funding is hard to get hold of at the moment, and is not enough to deliver the value that you've negotiated. So that is a huge point at the moment that factors into quite a lot of deals.
And I think, just picking up on one word there, Matt used, divergence is probably the best summary of the marketplace, with some areas suffering, others, though, to put it in perspective, I think there's still about $2 trillion in private equity globally looking for investments. I was up in London last week, where particular private equity is saying they're looking to do 20 investments in a particular sector next year. There really is that appetite for certain deals in certain sectors, rather than people reading the headline press of doom and gloom throughout. So I think it's really important to take that into account. And then, as we've got roughly about 10 minutes left, if we could then look at what are the practical things people would do at the moment to try and enhance value, to take into account that ahead of a transaction. What factors for all of you, perhaps you could come up with a couple each.
So I'll go first. Within the current market, the due diligence process is quite extensive and often quite protracted. When it comes to uncertainty in the future, quite rightly, buyers are being more cautious and looking at things in a bit more detail, and that tends to mean processes take longer. Things are identified during a process more readily, and that then either results in a price chip or perhaps a change in structure or value. So a key point for us at the moment is spending a good amount of time with a company in preparation for sale, to make sure that they can identify some of these issues that may be value detractors or potential deal breakers, and where possible trying to remove them, so that when they enter a process, they're as clean as possible. So this might be basic housekeeping. It might be making sure that some of they've tidied up some of their contracts. They've looked at some of their employment or customer contracts. It may be looking at their financials to understand what is it that a buyer may look at, and actually following DD change the price. So for me, it's preparation is absolutely fundamental in the current market, making sure that you're ready and that you're going to stand up to a due diligence process. And what that may mean is actually doing a vendor due diligence process. So quite often, the more typical approach is a buyer will do due diligence on a seller. What can be done is a seller does their own due diligence and gets an independent firm to do due diligence on themselves, and actually can go to market having already resolved some of the issues that come out of that due diligence. So they've almost gone through it themselves, and they're able to rectify things, so that when it comes to the deal, they're not suffering what that they would if a buyer had identified those matters. And I think it's also broadening beyond financial, tax, legal. There's a much more emphasis on things like cyber and ESG. What are the credentials of the business? What are the risks of that business, and what can you do to mitigate them before you go to market?
Thank you, Matt. Adam, briefly.
Yeah, I think I'll just sort of bring it full circle to one of my points at the start, just in terms of be aware of your options. So undertake that options review, know what's out there, know what's possible for your business at this point in time in this current market. I think that's a really useful step. Just speak to some people in the know and be aware of your options. I think is key.
Nicola?
Yeah, thank you. So similarly to what Matt was saying in terms of housekeeping and vendor due diligence, making sure your tax affairs are up to date and in good order. Also identifying any of the assets or liabilities that we've talked about before. So is there something there that you can get value for? Also, if there's anything that you want to do to, say, extract value from the company beforehand or do any kind of restructure, typically seeing at the moment quite a lot people wanting to remove freehold properties from the business. If you can do that in advance, that can be done tax efficiently. And another thing as well is if you want to any of that value to pass to some of the management team or employees, thinking about whether there's anything you can do in advance to set up a tax efficient incentive scheme as well. So quite a number of things to think about in advance if you can.
Okay, well, thank you very much indeed for all covering those particular points. I'm just picking up a couple of the other questions that have come through. Somebody's been asking what are typical multiples for evaluation? And I think I'll probably sort of say, having looked at multiples and transactions over the last 30 years, for an owner-managed business of a reasonable size, over that period, the multiples have been generally around 6 to 8. If it's a smaller business, maybe 4 to 6. But there's a whole range of factors that Adam went through earlier on that could influence that particular multiple. For a tech business, we could be talking 10, 12 times. It really does vary significantly by sector. Some of the other questions we've tried to answer there, and I hope that you've enjoyed the webinar. You can see the range of factors and details that's needed to be taken into account with something that on the face of it is very simple, but actually, like many things in life, is quite complex. What I'd say for all of you going forwards is preparation is key, exactly as Matt was saying. Understanding the valuation of your business, the factors that affect it, is far better to do that earlier with your own side, as it were, rather than as part of a negotiation. And as Adam was alluding to, understanding the options and what's possible in the current climate. So picking up what Nicola was saying about, whilst a number of parties, political parties, have said they won't look to change headline rates, but they may change some of the reliefs, the impact for you is that tax will go up. And certainly there's been absolute clarity that wealthy are more likely to get taxed more going forwards. So for some people, they're considering, well, they still think their business may grow in the future, but they're uncertain about it. Saying they may crystallize some of the value today, but actually have an earn-out. That value crystallized and the earn-out is going to be at today's known tax rates. The future, and in terms of where some of that earn-out comes through, will recalculate, but it will only be that element that will be exposed to future tax rates, whatever they may be post-release. And whilst people may not think the reliefs are great, I think in 2021, total tax reliefs accounted for 195, around 200 billion. And therefore, it really puts in perspective for all of us that it isn't just the headline rate, it's the effective rate we need to take into account. We will be putting events on early next year, looking at some of these factors and what else can be done about it. But if people want to have a discussion beforehand, please don't hesitate to get in contact with us. There will be a recording of this webinar available, LinkedIn and on our website. But if there are any particular matters you want to discuss personally for your business or those you're advising, please don't hesitate to get in contact with us so that we can assist you to be prepared rather than look back later on and going, if only I'd done X in time. So thank you very much indeed for your time. I really appreciate that, and have a safe rest of the day and enjoy your lunchtime. Thank you from all of us. Goodbye.
Bye.
Thank you. Cheers.